Hello guys, welcome all. I'm your host, CPA Leko Mohammed. So focus today is taxation of insurance companies. We're going to see how do we tax for those industries who are in insurance, those who are undertaking the business on insurance. So this video can both be, it can be a revision for both those who are preparing for business data or those who are preparing for the advanced taxation, uh, which is under advanced level. So welcome all guys. Let me read the question, then we start solving the problem. So the question reads, Malipo General Insurance Company Limited has provided you the following details with respect to its financial year ending at 1st December 2018. So we have the gross premium, 19 million, claims paid, 5.4 million. Then we have the claims outstanding. 1st January 2018 is 740,000. Claim outstanding as at 1st December 2018 is 1.64, 1,640,000. Then we have claims recovered on reinsurance, 400,000. We have legal expense relating to claim, 540,000. Commission or reinsurance accepted, 2.8 million. Commission on insurance ceded, 860,000. Reserve for an expired risk, 1st January 2018, 980,000. We have agency expenses, 1.56 million, 1560, 1,560,000. We have bad debt, 450,000. Next is life insurance fund, 1,540,000. Depreciation, 630,000. Foreign exchange gain, 420,000. Dividend from life assurance fund, 180,000. Management salaries, 1,670,000. Bonus utilized in reduction of premium, 425,000. Rental income on premises, 1,260,000. Repair of rented premises, 2,080,000. Advertisement expenses, 124,000. Purchase of furniture, 120,000. Return premium, 1,230,000. Reinsurance premium paid, 670,000. Then we are told additional information. The company acquired a saloon car for the general manager for sharing 2 million on 1st July 2018. Next, bad debt relates to compensation due from reinsurance company under receivership. Management salaries include wages amounting to 670,000 for part-time employees working in life assurance. Required, A, taxable profit or loss for Malipo General Insurance Company Limited for their ended at 1st December 2018. B, tax payable if any. So let's start working out this question. We know how do we tax insurances. So then we just begin with the name of the company, which is Malipo General Insurance. Malipo General Insurance. And we are going to prepare what? Taxable in 2018, taxable income, taxable income for 2018. So we're going to have 4 columns. First, we are going to start with incomes, those taxable income. Then we are going to have here shillings, and then shillings, then a place for the totals. So first thing we're going to start with is what is the first income? We are going to start with the gross premium that we have it here. This is the gross premium that I'm highlighting it. So I can say it's equal to gross premium. Then the amount there for the gross premium, we got the second column we are going to use for expenses. So you can see in gross premium amounting to equal to 19 million. So that's the gross premium here, 19 million. But out of the gross premium, there are two things we need to subtract from the gross premium. So we normally subtract the return premium, and you can say less return. We're going to subtract the premium less the premium returned, less premium returned. So we're going to subtract the premium that has been returned from the gross premium. The premium returned, if you have it, this is the premium return. Return premium is here, 30 million. So you can say, since you're subtracting, you can say it's equal to 10 minus, you can just come to and scroll to 12 that. You're going to subtract that. You're going to subtract that 1230 less premium returned. You're also going to subtract reinsurance on the premium. Premium reinsurance. Reinsurance on the premium. Reinsurance premium. You're going to subtract the reinsurance premium. And if you see in the question, we have reinsurance on premium. We have it here, reinsurance premium paid. So 670,000. So we are going to subtract. We're also going to subtract less reinsurance premium. Reinsurance. So this gross premium, we are subtracting only two things: the premium returned and the reinsurance premium. And the reinsurance premium. And if you look at this reinsurance premium, we have in the equation as 670,000. It's equal to minus 670,000. So I can just put it with a comma, 670,000. So we can get our net premium. We can get our net premium, whereby we take, we're going to take 19 million, subtract minus, so now these things we are subtracting should be plus. Since this has a minus sign, then plus also 670. So our net premium is 17,100,000. That is our net premium. This is our net premium. So you're only taking the gross premium, you subtract the premium returned and the insurance premium paid. You can add here paid. The insurance premium paid. Then we get our net premium. That's one of the income. Now we look for any other income that we have. This is one of the income, because this premium requires adjustment. From the gross premium, you need to less the premium returned and also less the insurance premium paid, so that we get the net premium. Net premium is one of our income. Now we need to look for other income so that we get our total income. We less the allowable expenses. We continue. We look for any other income that we have in the question. So we have claims and expenses, claims recovered from the insurance. Claims recovered, nothing will affect the workings of the claim. It will affect the working of the claim. Claim on reinsurance ceded. Yeah, this is an income. Claims on reinsurance ceded. This is an income. Claims on reinsurance ceded. So this is an income. We are going to have amount is 860,000. So the amount here is 860,000. 860,000 income. It's another income. So if you look at this also, this another income that we have is relating to this reserve. The reserve for an expired risk is 980,000. Normally for reserve, we have two categories: increase in reserve and a decrease in reserve. If there was an increase in reserve, that is an expenses. But if it is a decrease in reserve, then that is an income. For this question, they have only given us the reserve as at 1st January. They have not given us the reserve as at 1st December. Let's say this reserve as 1st January is 980,000. 980,000. Then maybe, let's say, for example, the reserve at that 1st December add up to 1 million. Then that means there's an increase in reserve by taking 1 million, subtracting 980,000. There's an increase of reserve of 200,000. Then this 200,000 should be, this 200,000 now should be, this not 200, but 20,000 should be an expenses, because the reserve has increased from 980,000 to 1 million. That is an expenses. But let's take, for example, the reserve has decreased from 980 to 900,000. There's a decrease of 89,000. Then that is an income. But now for this case, we are not being given the reserve at the 1st December, so we call it zero. Then we have an income of 980,000. So the whole of this 980,000 will be an income, because we are not being given the reserve as at that 1st December. Now we assume that the risk reserve for risk has been decreased to zero. So if you take 980 minus zero, you will get 980,000. So that's how we are going to do that. But if you could have been given a figure, you just compare with that. Increase, decrease. So now we have, we can say decrease, because decrease is an income. We are assuming that this thing has decreased to zero. Decrease in expired risk. Decrease in reserve. Decrease in reserve. Amount there is 980,000. So we also have foreign exchange gain. We can now, for this one, we can make an assumption. If it is, we can only use if it is realized. So we can assume that it has been realized. So we can take that foreign exchange gain. We can assume that it has been realized. We assume that it has been realized, 420,000. So we have exhausted. We also have bonus. Sorry, the last income is bonus. We have here bonus utilized in reduction of premium. Bonus is an income, this bonus. So we have bonus utilized in reduction of premium. The amount there is 425,000. 425,000. Now we can get our total income, so that we're going to subtract it from the expenses. From the gross premium, from the net premium, we look for other incomes. Then you get the total taxable income. Now you can say this is total total taxable income. From this, we get, we say we are going to take out of sum. We say sum. Start with this net premium, shift plus 860,000, and then we drag We close the bracket, sorry for that. We can say it's equal to, but add to 860, add to 980, add to 420, add to 425, close the bracket, enter, cancel. We just, there's no need for us to close the bracket. So, sorry for that. Just a minute. We take 17 million plus this 860 plus 980 plus 420 plus 425. Enter. We have 19,785,000 as our total income. Then we less allowable expenses. We less the allowable. We less the allowable expenses. Now we look for those allowable expenses. The first thing we need to study is the claim. Claims requires also some adjustment because we have there is a claims. If you look at the question, we have claims paid, claims outstanding at 1st January, that 1st December, claim recovered on reinsurance. So claims require some adjustment. The first thing we are going to start is the claims paid. So we are going to start with claims paid, and say is equal to claims paid, which is the amount here. So I'm going to have the claims paid is equal to if you look at the question, the claims paid is the claims paid. So we need to scroll up. Claims paid is 5,400,000. That's the claims paid. Now from this claims paid, so we are going to add the one at the end. Remember this 1640. We can say this claims paid, we just say add claims at 31st December, which is the closing. We are going to add the one that was December, and the December is 1640. The one that was December is 1640. If you look at the question, we have claims as at that 1st December is 1640,000. Now we are going to less the claims at the previous year, which is the 1st January, less claim at 1st Jan, which is equal to the claims at 1st Jan is 740,000, this one. Now, from that, we also have claims recovered. We also have claims recovered. Claims recovered is here. Claims recovered on reinsurance, 400,000. So there's claims recovered. Claims recovered, which comes to, so is equal to claims recovered is 400,000. That is claims recovered. It should be a subtraction because it is claims recovered on reinsurance. So we need to subtract that. That's been recovered. We are going to less that claims recovered on reinsurance. Claims recovered, we have to subtract that because it's one that's recovered on reinsurance. Now we need to get the net claim. We need to get the net claim. Net claim. Net claim. We just go with, we go to home, then we select auto sum, then we just enter 5.9 million. That is our claims, net claim. which is 5,900,000. So we also have, apart from claims, if you look for those other, you're going to look for other expenses. We have this legal expense relating to claim. So we have legal expenses. Legal expenses. But these legal expenses, it is relating to claim. So you need to subtract it from, we are going to subtract it from, let me start a row. We have legal expenses because it's relating to the claim. So you need to subtract from the claim. Legal expenses relating to claim is how much? It will be 540,000. 540,000. 5 minus 540,000. So you have that as 5 million. So you need to update this now. Update this table. 5,360,000 because you need to subtract the legal expense relating to claim. So you have this claim that was paid. We're going to add the claims that are 1st December, subtract claims at 1st Jan, subtract claim recovered, subtract the legal expenses on claim. Then you get our net claim. So you look for other expenses. We're done with the agency. So we have commission on reinsurance accepted. This commission on reinsurance accepted. So we have commission on reinsurance accepted. The amount there is 2.8 million. 2.8 is here. Other expenses, commission on reinsurance accepted. We also have the bad debt. The amount of bad debt comes to 450,000. But in the additional information, we have been told bad debt relates to compensation due from company, insurance company under receivership. So we can just ignore that bad debt because it's relating to a receivership company. We just disallow that. Next, expense that we have here, like no depreciation, no foreign exchange gain, no dividend, no. We have management salaries. We have here management salaries. So for management salaries, there is a note for, we have been told. If you look at additional information number 3, remember the management salary here is 1.6 million. But if you look at additional information I've been told, the management salaries includes wages amounting to 670,000 for part-time employees working life insurance. So life assurance, we are going to disallow that 670. So if you look at management salary, it's going to be, we are going to take the 1670. We're going to take 1670,000, subtract we are going to subtract how much? 670,000. Comes to 1 million. So let's go to the equation also. We analyze one by one. Bonus, no. Rental income, no. Repair of rented premises, Yes. Before that, we have this at the top, agency expenses of 1.5. So you have agency expenses 1560,000. Then we have, so, and if you look at the Income Tax Act, there's what we call specified sources of income. So some examiners will require you for the rental income to have a specified sources of income for the rental income. Whenever you take the rental income, you less those expenses and subject to the normal tax, if it is more than 288,000 annually. But if it is less than that, you go to MRI, monthly rental income. But for now, we're just going to take as other incomes. But it's what they call specified source of income, whereby you need to specify those sources of income. But now we can just we can assume that rental as part of this. So, but we take the repair of rented premises. The amount for repair of rented premises is 280,000. Then we have the next one after that is repair of rented. We have advertisement. Which comes to 124,000. Then finally we have this furniture will qualify for wear and tear. Managed salaries amount to 7. So we have furniture. So now we need to have insert a new row. Yeah, I think we need to insert one more row. We need to insert one more row because we have some 3 wear and tears. Now, so we have furniture. Furniture will qualify for 10%. These capital allowances, we take 10%. Multiply that with 10%, multiply with what is the furniture that is purchased? The amount there is 120,000. So here we just take equal to 10% multiply with 120,000. It's 12,000. So we also have additional information number 1, which says the company acquired Salunka for 2 million. So we have Salunka. Salunka will qualify for 25%. So it says equal to 25%. Apply with 2 million. Equal to 25 percent times 2 million 500,000. Then lastly, we have, let me start the new row. Lastly, we have other incomes. Before we take other incomes, we need to subtract this total. We need to get this summation of these expenses, starting from this net claim. So it takes equal to sum. We're going to start with this net claim because these are the not these are the first expenses, which is the net claim added to commission returns accepted. We're going to add all these expenses. So we know the total expenses. Then enter. So these are total expenses, which is we have minus here, so they get it in minus 11,600 at 6,000. Now we know this was our income and these are expenses. So we need to get the total income. Total income. Yeah, total taxable income, which we take equal to, we take this. We are going to subtract from the expenses since it was in a minus, so you're going to have plus this. And we have this our income. So we have other incomes. We are having another, we had what we call other incomes. Other income. But we have here rental income. We had other income, but we had rental income. And if you look at the rental income, it was 1230. If you look at the question that we had here, rental income was coming to how much? Rental income is 60,000. Now you need to get a total income by taking out of sum. This and this, we are going to add these two. Enter. So that's our total income, 9,409,000. Now for us to get the tax payable, we just take, remember this, just a corporate, for tax payable, we just take equal to 30%, 30% multiply with this 9 million. So this is the tax that should be payable. I said this rental income, there are some questions that require, not question, but this will be the way it will be done, whereby we have what we call specified sources of income. You have the rental income different, separated from this income. Now that's the question on the insurance. I hope you enjoyed it. See you in the next class. We are going to do more engagement on these tax areas. I was your host, none other than CPA Deko Mohammed. Kindly don't forget to subscribe to this channel to get more notifications for the content that I post. Thank you.